Hello, hello, MK Army. I'm Xander Kubler. Today we're talking about financial accounting. Lesson number 1, the bread and butter of your financial accounting 1 course, the balance sheet. Let's get right into it. So today we're breaking down the 3 components of your balance sheet. The first is your assets, followed by your liabilities, and within the liabilities, your equity. Starting with assets. Now, a company has 2 types of assets. Non-current assets and current assets. First, we're going to talk about non-current assets. Non-current assets are things that benefit the company, but are not expected to become cash within this fiscal year. So anything that basically isn't going to be sold or be given or transformed into money within the year. So a perfect example is a building the company might own. That doesn't become cash in a year. Machines, factories, things like that. Those don't become cash within a year. Investments aren't expected to be sold within a year. So all of those types of things. One important one to note is this intangible assets. So patents, copyrights, all of those things are expected to provide value over time. They don't provide value immediately in the same fiscal year. So those are non-current assets. Conversely, also in your balance sheet, you have current assets. Now, as you all might have guessed, current assets are assets which you do expect to become cash within the fiscal year. So the easiest of those is cash. But some maybe less intuitive options include inventory, right? Raw materials or finished goods that you're expecting to sell for money within the year. Another example is a tax credit from VAT, which if you're confused about that, there's a whole nother video on it linked below. But if a company has paid VAT tax and then they get a tax credit from the government within the year. So that's a current asset. Receivables, so buy now, pay later type things, where a company is expecting to receive money for something they've already sold. And then, of course, prepaid expenses. So anything the company would have owed but has already paid, that's actually an asset because later on when they owe that money, they've already paid it. So those are your assets. Those are good things, benefit the company. Non-current goes on top. Underneath is current. We'll show you that at the end. Now we're going to talk a bit about liabilities. Now, liabilities are debts or obligations that a company or a person owes. So opposite of assets, this is not good for a company, but it's the negative side of the balance sheet. Obviously, a loan, right? Money you owe back, that's a liability. Same with a payable, so something you are to pay in the future. Unlike a prepaid expense, a payable is kind of the opposite. It's the opposite of a receivable. You're going to owe money later. And then, of course, the opposite of VAT, tax credit, which is tax payable. Again, video in the description for more info on that. But of course, you just go watch the video. Finally, we have equity, which actually falls on the same side of the balance sheet as liabilities and can be considered under liability, but it's a little different. So I wanted to put it differently for you guys here. Now, equity is basically the holding of the company, and it makes up for the difference between assets and liabilities. So when the company is making money, to make sure the balance sheet is balanced, you see how that works? Equity will change. So obviously the shares of the company fall into equity. The reserves of the company that, dividends are going to come from the equity portion, all of this. And then, of course, net profit. So net profit can be positive or negative, and that's how that little equity section will always make sure that your balance sheet is balanced. So here's a look at a balance sheet. First, we talked about non-current assets. You'll see that in the top left. Then under that are your current assets we talked about in the bottom left. And then, of course, under financing or liabilities, depending on who you ask, you'll see liabilities first. And then you'll see equity underneath. So that right side, that financing side, will always equal your left side, your asset side. And that's what makes it a balance sheet. Wow. Anyways, that's all for this first video. Please don't forget to check out the rest of our videos, and thanks for watching.